Good Monday morning, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Shanali Bassick.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, it's the busiest week for S&P 500 earnings, with companies worth $20 trillion set to report results.
Plus, we have a wave of eco data, including the jobs report this week, to show how the economy performed during President Trump's first 100 days.
Meanwhile, a vote of confidence. IBM plans to invest $150 billion in America over the next 5 years. All of that and more coming up. But let's get specific here and look at some stocks. We start with NVIDIA dropping pre-market after a report that China's Huawei is getting ready to test a new AI processor that it hopes can replace some products made by NVIDIA. You can see shares a little bit lower right now.
All right. Also, Boeing is climbing today as Spirit AeroSystems makes a deal with Airbus that will lead to Boeing's acquisition of Spirit pending regulatory approval. So a lot of moving parts, but the bottom line is Boeing up 2%.
And let's take a look at big tech, where it's headed to start the week, because 4 of the Magnificent 7 stocks report this week, which is the busiest earnings week for the S&P 500 this quarter.
Yeah, specifically, we're going to hear from Meta and Microsoft on Wednesday after the bell. Then we have Apple and Amazon on Thursday. Bloomberg's Tech's Caroline Hyde has more on these high expectations for these numbers. And just to put that in context, so the Magnificent 7, Caroline, expected to deliver an average of 15% profit growth this year. That forecast has barely budged since the start of March, which feels like a long time ago. So the bar is still quite high.
It certainly is. You've seen companies, well, the analysts out there, downgrading the price targets. But we really haven't seen a budge in terms of earnings expectations. And I think, well, Dan Ives put his note out over the weekend just saying there's so much fog. This lack of clarity means even analysts, yes, you see them, Amazon in particular has been downgraded on its earnings for look ahead by about 2 percentage points over the last 4 weeks. But really, it's very resilient. What's going to be interesting about this fiscal quarter is the pull ahead. For the likes of Amazon, how many people have rushed out and bought goods on Amazon because they're worried that the price is going to increase? Now, according to Bloomberg Intelligence, about 70% of all Amazon products and from their third-party sellers come from China. So no wonder we're all worrying about the price points that are going to go up. So how much is there a pull forward there? How much is there a pull forward when you think about what's happening over at Meta? Now, remember, they get VR and AR over from China as well. But what's going to be worrying for the likes of Meta is how much are Shein, how much are Temu, how much are Chinese retailers and retailers more broadly cutting back on their advertising. Microsoft's probably going to do okay because it's all about Azure, it's all about cloud, it's all about us still using AI. But then you look at Apple, how much are they going to have seen a pull forward in terms of us rushing out to get our iPhones and our various equipment? Again, worrying about prices.
Well, what I'm waiting to see is how many of these companies are going to be cutting costs drastically. Yeah. We heard from Dow Chemical, we heard from Boston Scientific, we heard from Procter & Gamble, we heard from so many companies last week that they're doing anything in their power to cut costs. And that means reducing headcount. That means not opening new factories. That means maybe putting off leases for AI data centers. So what do you think we're going to hear from the big ones?
And look, you have been leading the charge on the worry about leases and AI leases being cut back in January, when we were just worried more about the DeepSeek concerns that arose in February and in just an over-exuberance rather than what's happening in the macro economy. But then you look at Alphabet. End of last week, they still stuck by their $75 billion capex expenditure. Most analysts think that they're going to remain committed to the extraordinary amount that they're all going to be spending, whether it's Meta is one of the biggest spenders, Amazon's one of the biggest spenders, and of course Microsoft is too. The data center rollout is still going to probably look relatively resilient because it's long-term in nature. But in the short term, how much are we going to see once again a focus on cost-cutting and cost control from a headcount perspective? Remember, Amazon's been on this years-long focus on trying to strip out middle people, trying to ensure that they get to do more with less from a personnel perspective.
Caroline, we thank you so much. That is Caroline Hyde of Bloomberg Technology. More on that at 11 a.m. for Bloomberg Technology. We're going to bring you back to the trade front. Cargo shipments from China to the U.S., they're plummeting by as much as 60% as tariffs begin to impact supply chains. And this weekend, President Trump sounded hopeful for a deal.
They want to make a deal, obviously. Right now, they're not doing business with us. You know, people talk about going cold turkey with China, meaning just forget about it. We were losing hundreds of billions of dollars a year with China, and now they're not doing any business with us, you know, not because of them, because of me. Because at 145%, you can't do business. But something's going to happen that's going to be positive.
Meanwhile, China today said it is not in trade talks with the United States right now. And Treasury Secretary Scott Bessent says it's up to China to de-escalate because they sell 5 times more goods to the United States. Bloomberg's Tyler Kendall has joined us now from the White House. Tit for tat, where do we stand right now, especially given the latest comments from the Treasury Secretary?
Yeah, hey, Shanali. Well, the disconnect between Washington and Beijing is continuing. You mentioned China's foreign ministry there saying that there are no talks currently happening. But then the Treasury Secretary this morning said that, quote, all aspects of the U.S. government are engaged in talks with China. Now, I did shout a question to the Treasury Secretary when he was done here at the White House, asked him who exactly is the point person leading these talks. He did not answer, but we do know from our Bloomberg News reporting that an important precondition for Beijing was that somebody else other than President Trump be appointed the point person to lead these talks. Now, the Treasury Secretary himself did say that he was in touch with his Chinese counterpart last week during the IMF spring meetings, but we did not get a readout of that meeting like we have with some of the past meetings that he held last week. He did say, though, that they discussed financial stability. It appeared, according to him, that trade was not the main focus of those discussions. Still, this White House is reiterating they think that a 145% levy that's currently imposed on Chinese goods is very high, amounts to a trade embargo, but at the same time, they want to see China ultimately take the first move here. We're going to have to remain watch to see how this develops. Scott Bessent called it a special negotiation separate from 17 other countries that the U.S. is negotiating with. He said that we could expect the technical details of some framework agreements with some other trading partners, particularly Asian countries like Japan, India, and South Korea, to be announced as soon as actually this week.
Yeah, well, let's talk about that a little bit more because we heard from the White House press secretary a couple minutes ago saying that Treasury Secretary Bessent is scheduled to join the press briefing on Tuesday at 8:30 a.m. Wondering if there's anything to read into that, Tyler.
I mean, potentially. I have to tell you that I'm at the White House early often, and this is the busiest I have ever seen it. It is clear that the White House is trying to start the day early with some of these headlines, particularly as we start to see polling come through that shows that Americans are growing increasingly concerned when it comes to President Trump's economic plans amid the tariff fallout. Now, we could expect to see some of these details. It really does remain to be seen. They are telling us technical details are being worked out this week when it does come to those 3 trading partners, India, South Korea, and Japan. But also, we're not quite sure exactly what is going to be in those framework deals. It's sort of serving as like a letter of intent almost that they are going to put this deal in place. Potentially we could see revised tariff rates, and then ultimately they will work towards a larger, longer term deal down the road. Now, with that said, we're still waiting for clarity on exactly what the administration is looking for, but Bloomberg News is reporting that at the moment they are now putting forth a more concrete framework for these discussions that will have specific columns that they're trying to tick here when it comes to tariffs, non-tariff barriers, but also digital trade is one of them, as well as economic cooperation. So we're starting to see maybe some of the contours of those deals emerge.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall reporting for us from the White House lawn, standing in front of a slew of posters of people that the White House has, that President Trump has deported. It's going to be a busy week of economic data ahead from PCE, inflation, to GDP growth, to Jobs Day on Friday. Here with a look at the week ahead is Bloomberg's Mike McKee. So, Mike, what do we expect?
You remember economic data? We used to have economic data move the markets. I think this week it's going to be between Carol and me, the tech company earnings or the economic data. We'll see how the markets react to this, but it's going to be a very busy week. We've got trade tomorrow, and that's going to be something people are focused on from now on, basically looking at imports. Jolt's not so important now, but consumer confidence. What are consumers doing these days? Wednesday is what I've called acronym day, ADP hiring, GDP, economic, the employment cost index, and the PCE inflation numbers, along with income and spending. Thursday, jobless claims and ISM manufacturing. Everybody's going to want to see what new orders look like there. Are we seeing businesses pull back on spending? And of course, Friday's jobs day. Everybody's going to be paying attention to that. The good news, though, no Fed speak this week. The Fed is in its blackout period ahead of next week's jobs. So you can see all the Fed speakers there on the screen. Everybody gets to take a break from that.
Well, one thing that I find very challenging to parse through is that you have the confidence data coming in earlier in the week and then the jobs data at the end of the week. So paper covers rock, does it not?
Well, the interesting thing about all this is a third one you mentioned is the consumer confidence numbers tomorrow from the Conference Board. a lot of what they incorporate is people's feelings about the labor market. And economists have said over the years that when people say jobs are hard to get, that's when you start to see the job numbers go down. So we'll see if there's any kind of correlation there. And we'll also see what the manufacturers are saying about employment.
All right, Mike McKee, we're going to see a lot of you this week.
Lucky you.
That is Mike McKee, of course, our international economics and policy correspondent. Meanwhile, check on this market ahead of a very consequential week. You can see in the pre-market, not too much higher, but a little bit on the S&P 500, coming off a 4.6% weekly performance last week. The NASDAQ 100, the Russell 2000, also quiet, but still modestly higher. Now, coming up, betting on America. IBM announcing a $150 billion investment in the U.S. We'll discuss next. This is Open Interest.
Let's get to high interest, look at what's making headlines around the world. Most of Spain and all of Portugal were hit by a major blackout that impacted public transport, power, and phone lines earlier today. The government is trying to determine the cause of the outage. Companies in Spain sent workers home, and the streets of major cities quickly filled with people, with police controlling traffic. A countrywide blackout is very unusual for any European country, with no event like this in Spain in recent memory. So we'll continue to keep you updated on that. Voter discontent with President Trump's economic stewardship is sinking his popularity as he approaches the symbolic 100th day of his term tomorrow. Polls from outlets including NBC, ABC, and Fox News show that voters perceive Trump to be falling short on his core campaign promise to strengthen the economy, with only 39% of Americans approving of his economic stewardship. Trump's strongest polling issue is on immigration in most of the polls, which is why they've dotted the White House lawn with those posters of people they've kicked out. The discount Chinese retail app Temu is passing on nearly all of Trump's new import taxes to U.S. consumers. It will more than double the cost of some products, and in some cases, the taxes are higher than the products themselves. A $19.49 power strip, for instance, attracted $27.56 in import charges, nearly 1.5 times the price of the product. Fast fashion giant Shein is also raising its U.S. prices with hikes of more than 300%, Shanali, for certain items.
And Matt, I'm going to bring you a story now on IBM being the latest company to announce a multi-billion-dollar investment in the United States. And it is a large sum. It will invest $150 billion over the next 5 years to bolster U.S. tech innovation and manufacturing. The company saying, quote, today's announcement reaffirms IBM's unwavering commitment to the future of American innovation, igniting new economic opportunity in the United States and around the world. Joining us now, Mandeep Singh of Bloomberg Intelligence. My question about this sum looks large, but is it a new amount of money, or is this largely symbolic?
Well, so when I compare this announcement to Apple's $500 billion announcement, it kind of shows that these are the two companies that probably weren't investing as much in AI capex when you compare them to the 4 or 5 big hyperscalers, which will be spending almost in excess of $350 billion in capex just this year. So from that perspective, I mean, Apple, IBM kind of joining the party, and most likely AI capex related investment makes sense. It'll be interesting to see what are the areas they invest in, because we know with the 4 hyperscalers, it's all AI capex, getting that training and inferencing capacity. I'm not too sure whether IBM is that big of a player or wants to be as big of a player when it comes to the AI infrastructure. So those are the details we don't know about.
And symbolic or not, we know that that has certain currency with this administration. So interesting to see this list of companies coming out. I want to talk to you about a story that the Wall Street Journal broke over the weekend that certainly made the rounds. That is that Huawei is set to test a powerful AI chip that it hopes will eventually rival NVIDIA. And you combine this with DeepSeek from a couple months ago. It just feels like these existential questions are piling up for our tech giants.
Yeah, so in the case of NVIDIA, we know they're not allowed to sell the H20s anymore. And in that case, Huawei is filling up the void. And the case in point we have is what they have done on the smartphone side. Remember, Huawei launched their own chip. They used it in their own smartphone, and they have taken share from Apple. So if that is the playbook that investors can see, then clearly, the Huawei chip, and we know with AI, NVIDIA is pretty much the dominant player on the training side. On the inferencing side, everyone is trying to make a dent in terms of capturing some share. So maybe Huawei does have a play when it comes to AI inferencing, and I think that's what they're going after. It'll be interesting to see whether these models run as efficiently on Huawei chips, but clearly they have proven the chops on the smartphone side.
What are you hearing about job cuts? I mean, we led on investment, and we're talking a lot about CapEx, but it seems in this earnings season that CEOs are saying the one lever that I can control myself is costs.
Intel, for example.
Yeah, well, Intel, I think, was in a situation, a special situation. Because,
but Dow Chemical says it's not going to launch a facility that it was going to. Boston Scientific says it's going to watch headcount. You've got, Procter & Gamble saying this is the only lever we have. So in the face of uncertainty, we're going to reduce costs.
Absolutely. I think there is that aspect where when you don't know how your growth is going to look like in the second half, you will slow down. But AI is still the imperative that everyone seems to be focused on. And so far, from what we have heard, these companies, the hyperscalers, have reaffirmed their CapEx. The companies that are piloting these projects haven't really pared back. So to me, that is the key when it comes to what happens to AI spend. And we haven't seen any pullback so far.
I will also point out Domino's this morning said that it eliminated certain roles in the first quarter. Didn't have a lot of comments on AI spend, though.
Fascinating. We will keep an eye on that, of course. We are now have been joined by Mandeep Singh of Bloomberg Intelligence. My question, guys, is if they'll spend on CapEx but not on jobs in the next couple of months. We'll see what investors really want to see from these companies. Now we're near the opening bells. We're going to begin the trading day with BlackRock's Gargi Chaudhuri. Stick with us. She's with us next. This is Bloomberg Open Interest.
Well, Morgan Stanley's Mike Wilson is starting to favor the U.S. over international stocks. He believes that a weaker dollar will support U.S. corporate earnings, helping the American stock market outperform the rest of the world. Now, that differs from opinions from strategists at J.P. Morgan and SocGen, just to name a few. So let's ask someone else. Gargi Chaudhuri, she is BlackRock's Chief Investment and Portfolio Strategist for the Americas, joins us at the desk now. Great to see you in person, Gargi.
It's good to be here. Thank you for having me.
So I want to hear your opinion on the state of U.S. exceptionalism, because it's been one of the hottest debates over the past several weeks, and you've seen it play out in the stock market.
Absolutely. So we just came out with our second quarter outlook today, our spring investment directions, and we actually tackled this topic. And what we're talking about is in the U.S., obviously there continues to be a lot of volatility, whether it's around tariffs, whether it's around Fed independence, whether it's just around how much will growth slow down. It's no longer a question of growth slowing down, but how much that's going to be, and whether we're going to see the R word. On top of that, people are falling over themselves to be more non-U.S. focused versus not. So I think the way to think about it is, number one, how are people positioned? So we take a look at advisor portfolios, and we find that most investors are meaningfully underweight international exposures, meaningfully underweight Europe, EM, and we think this is a good time to bring that back up to at least market weight, because this story around other areas of the world continuing to keep up with, or maybe even extend versus the U.S. might have some legs. The second thing I think investors should think about is around what are the new broader opportunities that this creates. And I think in the U.S., what we're going to continue to learn this week is around AI. And the theme around AI CapEx, to the extent that that remains, we think that that remains an area of opportunity. And then lastly, I think within the U.S., just continue to think about maybe reducing your volatility with minimum volatility strategies.
So wait, you think the AI CapEx is going to continue, or at least remain as strong as we expected? Because we've been seeing estimates of like $2 trillion over the next 5 years, right? So, and that was in the run-up of this market, not in the drawdown that we've seen. You still think we're going to see those numbers hold hold steady?
Yeah, I think we're going to learn a little bit this week. And obviously, just when we look at some of the Mag 7 names, we're expecting to see over $300 billion in CapEx for this year alone. And as of right now, when we look at what has unwound the most this year, even amid slowing growth, it hasn't so much been cyclical. It's been the broader large cap tech names. So what we're telling investors to do is actually think about software as an exposure. And we've seen a tremendous amount of inflows into an ETF ticker IGV, which we think makes sense in this environment. And then for AI, and specifically mapped to your question around CapEx, we think that that remains for now, but taking a more active approach to investing within AI, we think makes some sense.
So how deep do you dive into this market? We have seen a lot of profit taking. We've seen a lot of risk off the books of hedge funds and other big institutional investors. Do you think it's safe enough to really get in given the volatility that you expect ahead?
You know, I think when we look at just the volatility, to your point, that we've seen over the last month and a half, I think investors who've completely left the markets and moved to cash have missed out. And when we do investor polls for our client calls, what advisors are telling us, and even institutional clients are telling us, is that they're looking for opportunities to hear from us and others about how to reduce their volatility and yet remain invested. So about 25% of investors that answered our polls talked about looking for strategies to reduce volatility. And we think this is where stay invested in equity markets, in U.S. equity markets, but reduce your volatility with things like the U.S. minimum volatility strategies.
All right, we're going to dive deeper into that next. Gargi sticking with us through the opening bells, and here's the setup as we head into it. You can see the S&P 500 building a little bit on that pre-market rally. Pretty muted moves when you consider the performance that we saw last week, but it's a consequential week of earnings, so we'll see how those lines change. The opening bells are up next. Don't go anywhere. This is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller, and it looks like last week's big gains have left some momentum in the S&P futures. Only 0.1%, and less than that on NASDAQ futures. But this week, we're going to get a ton of earnings. In fact, $20 trillion of market cap is going to report this week. So I think earnings, it's fair to say, will overshadow the economic data, at least until Friday when we get jobs. This is weird, right? This is not the New York Stock Exchange. In fact, it's somewhere in San Francisco. There's a cybersecurity conference, and they've decided to ring the bell for the NYSE there. I don't know that I would have made that choice. This is more interesting. On the NASDAQ, Erie Insurance is ringing the bell. They've been in business for 100 years. They've been listed on the NASDAQ for 30 years. And I went back and looked at the performance over the last 3 decades. They're up 5,600%. So more than twice the NASDAQ and more than 3 times, Katie Greifeld, the S&P 500.
Pretty exciting for an insurance company. You mentioned earnings, and you're right. We just have a wallop of earnings this week. 4 of the Magnificent 7 stocks report this week. As you said, that is the busiest earnings week for the S&P 500 this quarter. You can see some of them in the pre-market, or rather just the open market right now. Not too much information to glean from what they're doing today, but it'll be fascinating to follow these stocks over the course of the next few days. Sonali.
I'm looking at Boeing over here, Katie. It's up 3% at the market open. They're climbing as Spirit Aerosystems makes a deal with Airbus that will lead to Boeing's acquisition of Spirit pending regulatory approval.
Yeah, that's a little bit difficult to wrap your head around, but we're going to get to Benny Kammel in Berlin to explain all of that for you. NVIDIA is falling, you can see less than 1%, but it's a very heavy stock. This after a report that China's Huawei is getting ready to test a new AI processor it hopes can replace some products made by NVIDIA, which is already facing issues in China. Export blocks as well as import problems. We are back with Gargi Chaudhuri, BlackRock's chief investment and portfolio strategist for the Americas. And Gargi, I'm looking at this week of earnings and waiting for the outlooks, if they don't cancel their outlooks. You know, I'm looking to see how many companies are going to be cutting costs, because that's the one thing they can control, right? It's like a corporate serenity prayer. So what do you expect in terms of companies facing uncertainty?
Yeah, so we've looked at all of the companies that have reported so far, and obviously the negative sentiment has picked up meaningfully, and we're looking at words like uncertainty and volatility and lack of words like optimism. You have seen that. What we haven't seen yet is any direct talk about cutting in the way of labor market resizing. So we haven't seen that yet, and maybe we
haven't seen big layoffs.
Right, we haven't seen that yet, and maybe that's yet to come. One of the things that we are looking for is just around how many companies are just not providing a guidance anymore. And I think that's bad news, and I think to the extent that we get more and more of that, it's going to be really hard to justify what your PE is or might be, because you don't know what that earnings is. So that's what we're looking at, I think, and a continued uncertainty, questions about layoffs and right sizing, and then continued focus on whether companies are able to move their guidance lower or not.
I want to talk specifically about sort of the estimates, because guidance, who knows? And I have a lot of sympathy for the C-suites trying to put together their forecasts for 2025. But this is a stat that we were chatting about with Caroline Hyde. You think about the Magnificent Seven, still forecast to deliver an average of 15% profit growth for the year ahead. That's very similar to the start of March, and the world has changed pretty dramatically since the start of March. And when it comes to the earnings picture overall, that's something that we've heard, that you need to see these estimates come down, that heading into the heart of earnings season, the bar is still really, really high.
It is really high. And if you look at our investment directions in our first, in our equity outlook section, what we talk about is what you would have to believe for you to expect equity markets to continue to rally from here. What kind of expectations of earnings growth would you have to believe that we're going to get, and what kind of multiple expansion? Now, at this juncture, we're no longer at the richest end when you look at what our PEs are, but we're around normal to slightly rich, and earnings expectations right now still at double digits, low double digits, but still at double digits. Maybe that comes through, but hard to see, especially if we see real GDP slow down meaningfully. So that is why we think at this juncture, reducing the volatility of your portfolio, moving to certain defensive sectors, and then using parts of the fixed income market as a portfolio diversifier, as well as liquid alternatives and gold as areas of opportunity in the market.
As much as I want to bite into that fixed income point, I do feel like I have to stick on earnings, because even beyond big tech, it's actually 180 companies reporting this week alone.
Wow.
So I want to pull up what the S&P 500 has been doing by sectors, because you're seeing a lot of pain in most of them, particularly consumer-heavy ones. You look into consumer discretionary, actually Tesla's not even your worst performer there. And so
it's amazing how defensive this is. I mean,
very.
Only the things you need are gaining, right?
Yeah.
Staples, utilities, and healthcare.
Yeah, for the year. And Bloomberg Intelligence is saying that consumer sectors are starting to show cracks. Sales misses have surged. Guidance is the worst in Bloomberg Intelligence's records going back to the pandemic. So how bad really can this week get when you look at the consumer sector really dragging down the rest of the index?
I don't know about how bad. I mean, obviously we don't know that yet. I think what we've seen over and over again is that there is a lot of cash on the sidelines, and investors are looking for opportunities to buy dips. Those dips have to be pretty significant, though. I don't think it's a 3 to 4% dip, but I do think if we get back to a point like we saw in the beginning of April, where we did see some major pullbacks, a major re-rating, I think there are opportunities, there are pockets of opportunities, and I think software is one. I think, again, some of these very high quality, strong balance sheet AI companies are other, and again, pockets of healthcare, which is another area of the market that we like, that can provide that opportunity when there is that pullback. But if you're looking at your portfolio today and you're wondering what you should be doing, and you're concerned about earnings continuing to falter, or you're concerned about growth numbers, obviously we're getting Q1 GDP this week, you're worried about that, maybe having even a negative print in front of it, what should you do? And this is where we think about maybe reduce the volatility of your portfolio, don't move to cash, reduce your volatility, move to more defensive sectors, add some diversifiers, and stay invested.
We have had, though, some pretty dark forecasts. I mean, Torsten Slok sticks in my head with a barrage of data over the last couple of weeks on his voluntary trade reset recession, right? He says 90% chance. And over the weekend, Ryan Peterson of Flexport says that ocean container bookings from China are down 65%. If you look at a map Bloomberg has a fantastic terminal function, Maps Vessels Go. You can see that all of the dry goods container ships are holding on the Chinese coast and not coming here. It seems pretty dire to me, right? Empty shelves.
Look, I do think that we haven't yet begun to see the impact of some of the ideas that you're talking about in the market. We really haven't. We've seen the soft data be pretty weak, but the hard data, even if you looked at the durable goods number last week, has been pretty resilient. As we get into the meat of Q2 and as we begin to see some of the impacts of consumers feeling the stresses of higher inflation and higher prices, as we begin to see that in the actual hard data and in people's experiences in shopping and buying things, I think that's going to have an effect on equity markets. I do not think that has happened yet, and which is why I think investors should get ready, start preparing a more defensive portfolio, and look at areas of opportunities within fixed income and gold and other liquid alternatives to build that more resilient portfolio at a time when we do think growth will slow down from the very robust levels we saw last year.
I think that soft data, hard data dynamic is really interesting. I think it'll be really put to the test this week, and it is one that the Treasury Secretary in particular has been warning against. Don't worry about the soft data when the hard data is holding up, right?
Don't look behind the curtain.
Right, the politicized curtain.
I mean, to be fair, you've heard similar things from the Fed, maybe not in those terms, but they're looking at the data that they have, and to them, that largely means what we're going to see with PCE.
They'll wait for a recession to cut rates, right?
Exactly.
That's how it goes.
But when you talk about higher prices, something that I thought was telling was we had Domino's earnings this morning. One of the things they said was that the higher prices, they actually raised their prices, that was more than offset by negative traffic, and that sort of mix there. So I hear what you're saying, prepare a defensive portfolio, but it seems like even the trade down sort of trades aren't necessarily working with higher prices.
Yeah, I do think that we haven't fully realized the impact of higher prices in the markets yet. One of the things that we look at is, what are inflation break-evens doing? And one of the things that the Fed has been very comforted by is the stability of long-term break-evens. And, we're all comforted by that. But is this a time for investors to be concerned around those higher prices and add some inflation protection? We think so in the very front end of the curve. Buy some real rates because those are still attractive and they've moved significantly higher. I think that right now this has all been something we've read off in a paper. It hasn't quite materialized in our actual realizations of our experience yet in the markets or in our personal lives. I think it's about to come. And when that happens, I think you want to be invested, but you want to be very careful about where you're invested.
So what I'm hearing is sometimes the best offense is a great defense. Gargi, we thank you so much for joining us this Monday morning ahead of a very busy week. That is BlackRock's Gargi Chaudhuri. Now let's get a look at some more stocks on the move with Bloomberg's Isabel Lee. Isabel.
Hey, Shonali, we're looking at Domino. So we have the company's revenue that slightly missed estimates, but we have the profit that was higher year over year. Ahead, we have Domino seeing a 2025 operating profit growth of about 8%. And get this, Domino said it doesn't see tariffs having a material impact on its operational profit. But the company did also say that macro and geopolitical volatility will be affecting international demand. Up next, we have Merck. So this U.S. biotech firm is edging kind of flat. The company agreed to buy SpringWorks Therapeutics to boost its healthcare division for $47 per share in cash. So this represents a total value of around $3.9 billion and a 26% premium for SpringWorks. So SpringWorks is a maker of medicines for cancer and rare diseases. And this purchase is expected to boost Merck's overall healthcare division because SpringWorks has a drug portfolio that's already approved by U.S. regulators. And lastly, we're looking at Airbus. So this is an interesting acquisition. We have shares edging higher by around 5% for Airbus and for Boeing also as well, around 3%. So if Europe's Airbus agreeing to take over some assets and sites from Spirit Aerosystems, and this clears the way for Spirit to really be acquired back by Boeing, its former parent. So the deal includes Airbus taking over facilities in North Carolina, France, Ireland, and Scotland. So the Airbus deal is really a part of this complex three-way transaction that reunites Boeing with Spirit. And we have Bernstein upbraiding Boeing, saying it is now making, quote, progress that it needed for the growth trajectory. Back to you.
All right, Isabel Lee, thank you for that roundup. Isabel mentioned the Merck SpringWorks deal. I'm pleased to say we'll be speaking with Germany's Merck CEO next hour. But coming up, cargo shipments from China to the U.S. are plummeting, and a U.S. supply shock could be on its way soon. Matt Miller has an awesome chart to show you. We'll bring it to you next. This is Open Interest. All right, it's time now for Top Calls. Some of the analyst action in focus this morning. And first up, Eli Lilly getting double downgraded to a sell over at HSBC. The analyst says that there's too much optimism in the share price and that the risk reward is not attractive. Next up, we have Jack in the Box getting upgraded to a buy over at Stifel. The analyst says the new CEO has created a plan to strengthen the balance sheet. Apparently, Stifel thinks it's a good one. Shares up 2.8%. And finally, we have Rithm Capital getting raised to a buy over at Piper Sandler. The analyst says that the stock is overly discounted, and we'll be talking to the company's CEO next hour, Matt Miller.
All right, I'm looking forward to that. But right now, I get to show you the awesome Bloomberg function, Map Go. And if you type Map Vessels Go, you can see a whole bunch of ships around the globe. You can eliminate passenger ships and look at those just carrying dry goods. And you'll notice that they are all stationed right off the coast of China. They're no longer setting sail for the U.S., which is what we heard from Flexport over the weekend, that 65% of shipments are down, that 25% of the sailings over the past 2 weeks have been canceled. And this, Shanali, is a real problem for the U.S. economy, or will turn into one in the next couple of weeks.
Yeah, you really can see the satellite imaging showing you the clusters in China relative to the U.S. Amazing map. We'll keep an eye on it throughout the course of these tariff tensions. Now, fast fashion giant Shein is raising prices ahead of imminent tariffs on small parcels. Items from cleaning towels to wax strips are all seeing hikes as high as 2,000%, some even as high as 377%. For more on how this will impact consumers, we are joined by Poonam Goyal of Bloomberg Intelligence. We've heard similar stories from Shein, to some degree from Temu as well. But what about U.S. companies? When does this phenomenon hit Amazon in particular?
So it's already hit Amazon. We just don't see it. They're absorbing the price increases. We've heard from Amazon that they are going to keep prices low for as long as they can before pushing them off to consumers. That said, third-party sellers are raising prices because the 145% increase that they're facing in costs from China are impacting their bottom line. A big price increase will come this summer if we don't find relief to these current tariff levies that are placed.
And when you think about the ripple effect, like you said, I mean, you're already seeing it with Amazon. To see these moves from Temu and Shein, Matt, I think you called them the dollar stores of the internet in our morning meeting. But does this give an Amazon, for example, more room to pull that lever? Does it make it a little bit more palatable for them?
It does, yes, because now the competition is almost level setting the playing field, right? But that said, you also have to keep in mind that Amazon isn't just up against the Temus and the Sheins of the world, but also up against the Walmarts of the world. And Walmart had said that it will also push the pedal on price when it comes to keeping it low for its shoppers. So there's a lot to think about here. That said, when you think about Amazon, they have the deep pockets, right, that small retailers don't have, to go ahead and absorb some of that pain more easily. And I think they'll try to for as long as they can to make sure that the consumer stays and doesn't have to deal with higher prices, at least not at the level that you're seeing against Temu and Shein.
Yeah, it's going to be difficult for small businesses, and unfortunately, they do 80% of the hiring and CapEx in this country. Poonam, thanks very much for joining us. Poonam Goyal there from Bloomberg Intelligence. Coming up, Airbus clears Boeing's path to Spirit. That's next. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. After a 4-day rally of more than 7%, the S&P is still gaining. So I guess it's a 5-day rally now. It's more modest, only 0.25% higher on the S&P 500 right now, only 0.2% higher on the NASDAQ. The only earnings we've gotten so far really is Domino's Pizza. But this week is going to be the biggest in terms of market cap of the entire quarter, $20 trillion. In terms of the movers, NVIDIA, the big heavyweight right now, down almost 2% after that Wall Street Journal report that Huawei will challenge them on chips. But Apple is up 0.5%. These are the I guess the Magnificent Seven chiclets here. Amazon is up barely, Meta up a little bit. Here's a story we're going to talk about with Benny Kammel in just a moment. Boeing up almost 2% after it's getting approval or working out the math to buy Spirit because Airbus is going to pick up a piece of that. Kate, do you want to pick up on this story?
Yeah, let's get some more details here because like you mentioned, Airbus has agreed to take over some assets and sites from Spirit AeroSystem. This theoretically clears the way for the struggling U.S. aerospace supplier to be reacquired by its former parent, Boeing. So let's try to untangle this web now with Bloomberg's Benedikt Kammel. He leads our global aviation coverage. So walk us through the logic here. This seems like it's really good news for Boeing. Why does it make sense necessarily for Airbus?
Good morning. Yes, it's a fiendishly complicated deal. So we have Airbus on one side over here, and we have Boeing on the other side, and Spirit in the middle. Spirit is principally the supplier to Boeing, but they also supply some components to Airbus planes. And then when Boeing said last year that they would like to reintegrate Spirit after 20 years, Airbus said, well, OK, not so fast. We don't want you owning the workmanship of sort of your biggest rival. So they started sort of trying to untangle the operation, which is why it's taken almost a year to get this over the line. And then today we got the announcement from Airbus saying, OK, this is how we're going to do it. They're going to take over assets in the US, in Belfast, in Ireland, in Scotland, possibly in Malaysia. So really all over the map, making components for the A350 wide-body aircraft, for the A220, the smaller plane. And then step number 2 will be for Boeing to announce the closing of their portion of the deal. And then really sort of the cleanup job begins for both companies to get Spirit back to where they wanted it to be, because that's really the logic behind the deal. This is an asset that's important, but there's also been bleeding money, that's been bleeding quality. And Boeing's thinking is, if we get this asset back under our wings, back under the, the protective umbrella of Boeing, then we get a better product here.
Right. My question is, how messy is that process? Because Spirit was spun off of Boeing in 2005. Boeing, of course, has its own challenges at the moment, a transition year, if you will. What does bringing under these Spirit assets really mean for the company, given all the challenges you have outlined?
Well, it'll be expensive for both Airbus and for Boeing to really get Spirit back to where they want it to be. They need the quality to be much better. They need the workmanship to be better. And to remind people why we came to this place, it was a Spirit fuselage that had that blowout at the start of last year where that door came flying out. So that was shoddy workmanship on display, and that really forced Boeing's hand to reintegrate that business, as you say, after 2 decades. Sort of financially, it's a value-destructive deal for Boeing, but they had to do this just to gain control again of the asset. Airbus said today that they would put $200 million in credit towards Spirit. So that gives you a sense of just how dire straits that asset is in, just to help them sort of limp over the finish line until they're back on the Boeing books. But this is really a business that needs an injection, both in terms of expertise, but also capital. And that'll cost both companies dearly. We'll hear from Airbus on Wednesday, the report earnings after the close on Wednesday. And we might get a better sense then what kind of money Airbus will need to plow into their portion of the deal.
All right, Benedikt Kammel out of Berlin, thanks very much for your coverage. Benny runs the global aviation coverage for us out of the German capital, and he's wearing a brilliant tie from Ed Meyer in Munich. I highly recommend checking out that store if you get a chance. Let's look ahead to what's going on this week. Today, Canadians head to the polls in a snap vote called by new Prime Minister Mark Carney. And this week, President Trump marks his 100th day in office. Tomorrow's day 100. It's also the busiest week of earnings season, with 4 of the Mag 7, Microsoft, Meta, Apple, and Amazon, set to report. We're also going to get results from General Motors, Starbucks, UPS, and many more. And then on Friday, it's Jobs Day. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, bracing for earnings. It's the busiest week of the year for S&P 500 companies with $20 trillion worth of market cap represented.
At $3.9 billion pharma deal, we'll speak to the CEO of German Merck about their latest acquisition and what might be next in the pipeline.
Plus, we'll discuss the market appetite for M&A in just a moment with the CEO of Rithm Capital. All of that and more coming up. Let's take a quick check on these markets right now. Pretty quiet moves overall, but this time to the downside on the S&P 500. The Nasdaq 100 a little bit more, down about 0.4% ahead of a very busy week for the Magnificent Seven on the earnings stage. You also have the 10-year yield higher a little bit, but we are below 430. I will point out, Sonali, that volume is very, very light at this moment because it feels like the week doesn't really get started until Wednesday.
The 4.2% certainly feels better than 4.4%, doesn't it? It's time now for the Wall Street Beat. Joining us now, Michael Nierenberg, Rithm Capital Chairman, President, and CEO. And want to talk about those higher for longer interest rates because for a company that deals with the housing market, mortgages, but also credit markets more largely, to see this level at the 10-year, what is the ripple effect across all of your businesses?
So why don't we start with the mortgage market? And obviously a couple of weeks ago there was some big news where Rocket Mortgage bought a company called Mr. Cooper, and that was, I think, a $9 billion transaction. When you look at that deal and I think about where we are in the space, the one thing that we have, which is, and Cooper has as well, is a large amount of mortgage servicing rights. So when you look at our balance sheet, we have $850 billion of mortgage servicing rights. If interest rates stay higher for longer, our ability to actually manufacture cash for our company and for our funds businesses, it's pretty extraordinary.
Well, how does that work? Because you look at the Mr. Cooper deal, and frankly, a lot of this was because these companies have gotten so large. They're not all that many at this scale. You know, you were behind this business kind of when it was growing up back in a prior role. So what does this mean for your business? Because in the commercial break, you were giving us some pretty interesting math about what it means for your stock.
So we own, when I was part of Fortress, one of the companies that we grew was a company that was known then as Nation Store, which is now known as Mr. Cooper. In 2018, when we were at Fortress, we sold that company to KGaA. If you look where we are today, we built a very similar company called NewRez. And we just reported earnings, obviously, on Friday. So if you actually took the valuation of NewRez and you applied the same valuation that Cooper has, as a result of that M&A transaction, it would imply roughly a $20 stock price for us.
How do you plan on exiting NewRez? I mean, when you talk like that, I think maybe an IPO or is a sale a better choice?
Yeah, we're not going to sell the company. If you look at the world of credit, and actually moving on to credit for a sec, the kind of fundraising that's going on today is something called ABF, asset-based finance. This company makes a lot of money, and it provides a lot of cash flow for our investors. So I think the likelihood is at some point down the road, we'll figure out a way to simplify our capital structure, maybe up top, because we trade within the REIT space. And one of the things to think about is we trade roughly 5 to 6 times EBITDA. If you think about some of the alternative asset managers trading at 10, 15, 20, 30 times, if we could get that increase in multiple, and based on the amount of money that we make today, if we make $1 billion a year, for example, if you put a 10 multiple on that, it implies a $20 stock price again. So I think a lot of the things that we're very focused on is how do we create more shareholder value? How do we grow our private credit business? And in creating shareholder value, we need to take a look, to your point, whether we take the company public or whether we actually change our corporate structure a little bit.
Interesting, and I'm wondering whether you're thinking about further M&A because, okay, you're not going to sell NewRez, but you're known as being a pretty acquisitive business. Of course, a lot of folks know you from the tie-up with Sculptor, for example. You think about this environment right now. Are you looking to perhaps do some more purchasing?
So we've been pretty clear that we want to scale up our credit business a little bit more than where we are. So I would say the M&A calendar or pipeline is fairly active. The one thing that I point out that we traded, call it 6 times EBITDA. If you think about that relative to someone else that's trading at 15 or 20 times, we got to be extremely selective on the potential acquisition target that we that we're trying to source. But the calendar is pretty robust right now, and I think valuations have come in a little bit.
Speaking of valuations, beyond Rhythm's own potential M&A strategy, there's a word that I really love in markets right now, opportunistic. Back in the day, this used to be considered distress, but no one's calling it distress these days, maybe because these assets are not quite so dire in their straits right now. So what are you finding out there in terms of deploying a lot of capital for opportunistic real estate, credit, anything else that's sold off?
So if you look at the volatility we've seen in the markets the past kind of couple months, we've actually taken that opportunity to source assets and buy assets. And again, going back to the word ABF, we could actually go out now and source assets that are kind of mid-teens type returns. That works extremely well for our funds business, and it works extremely well for the public company on the balance sheet side.
What do you expect in terms of opportunities coming up? You know, we talk about Torsten Slok a lot on this program from Apollo, and he's been putting out some warnings about thousands of layoffs, bankruptcies at generational retailers, you know, a recession coming because of empty shelves and COVID-like shortages. Do you buy into that?
You know, I'm concerned. I mean, we should all be concerned that, you know, the more and more layoffs that you see, I think it's going to be, you know, how does that really weigh on the economy, and how do we think about our overall businesses? And actually, does that play into some kind of opportunistic, distressed environment? I don't think we're there now. You look at our delinquency characteristics on our mortgage portfolios, and delinquency trends are actually trending lower right now. I think it remains to be seen what's going to happen in the third and the fourth quarter.
I want to talk a little bit about your share price because we've mentioned it earlier in the show that you got an upgrade over at Piper Sandler on your valuation potential just this morning. They say that your stock is overly discounted. I want to look at how you've performed over the past 5 years or so, because at least according to our data, you're up 192% on a 5-year basis. That is outperforming the S&P 500 there, or at least on a total return basis.
And he just said it could double with New Res.
Exactly. But one of the reasons that Piper Sandler has this view is that they have a whole list of reasons, but one of them is your ambitions to grow asset management further that could enhance the valuation. So just talk a little bit more about the opportunity set when it comes specifically to asset management.
So obviously in 23, we did the transaction with Sculptor. That's working out extremely well. You know, recently you probably have seen in the press the real estate team has raised $3.2 billion for their opportunistic real estate fund, the largest one they've done in 20 years. Their track record is excellent. We recently announced a credit opportunities fund at Sculptor as well, closing on $900 million. So we're starting to see some real flow come onto the platform at the Rithm level as well. So as we grow our asset management business, and then you change that so-called multiple valuation, that's really our goal. How do we get a better valuation for what we're currently doing every single day? And there's really no change. It's not like we're going to change how we think about the world just to grow in AUM. We need to grow in performance. Performance is going to lead to more AUM. But I think overall, if you go from a 6 multiple to a 10 multiple or 15 multiple, that's really going to be your pop in the valuation of the equity.
You know, it's pretty remarkable to see anybody raise funds in this environment, frankly, and you guys have raised billions. And so what is it that investors want right now, particularly in private markets and credit markets? Are there places that they're avoiding?
You know, it's a great question. One thing I didn't touch on is we recently launched a platform called Scale, which is energy and infrastructure. So some of our old Fortress colleagues are joining us to build what I would call power plants for the hyperscalers. So that's something that's an ongoing business. When, you know, I guess when we look at the world and we think about where we're going to go and what investors really want, they want partnerships. So we're going to grow with partners. This is not like, I think back to the old days and all the M&A stuff we did. If we'd go out and buy a company, we'd go raise, you know, $1 billion of equity, for example. Having real partners around the globe is something that's going to really enable us to grow. And I don't think it's really specific to us. I think it's more broadly in the alternative asset management business. And I think we're on the right path now. You know, the past couple of years, we did a lot of brand building around the house. And I think now we're going to start to see the fruit of that labor really come into play for the company.
Well, it's a very cool story, Michael. We hope we can have you back on the program on a regular basis. Michael Nierenberg there, the CEO of Rithm Capital. Now, coming up, Steve Sosnick, Chief Strategist at Interactive Brokers, joins us. He says there are still valid reasons for caution in these markets, even after the big gains we've seen over the last 4 or 5 sessions. We'll talk with Steve Sosnick next. This is Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Ukrainian President Volodymyr Zelensky said he's hopeful for a reliable and lasting peace after meeting one-on-one with President Trump at the Vatican on Saturday, just before the funeral for Pope Francis. Meanwhile, Russian President Vladimir Putin earlier today declared a 3-day ceasefire in Ukraine next month. It's the second time in 2 weeks that Russia has promised a pause in the fighting as Trump grows impatient with Putin's refusal to stop the war. Millions of Canadians are headed to the polls today in a snap federal election that is largely focused on how the candidates would respond to President Trump's threats of tariffs, as well as his call to make Canada the 51st state. Prime Minister Mark Carney, the current leader of the Liberal Party, called the election in March shortly after taking over from former Prime Minister Justin Trudeau. And it's the worst blackout in Europe in years. A network outage left almost all of Spain and all of Portugal in the dark today. Some areas of Spain have come back online, but the grid operator says restoring all supply in the country will take until at least tonight. Sharp swings in power usage are said to be the culprit. A countrywide blackout is very unusual for any Western European country, with no event like this in Spain in recent memory. Katie?
All right, we'll continue to follow this story, but let's get back to these markets right now. There's not too much to look at on the S&P 500, almost perfectly unchanged. I want to highlight volume, though, down about 16% from its 30-day average when it comes to trading volume. That's because the week doesn't really start until Wednesday, Matt. That's when you get Meta. That's when you get Microsoft in the afternoon. And in the morning, you get GDP versus PCE, which sets up the tension of this week nicely. Is it earnings or is it the eco data?
Yeah, that's really been the overriding question. Let's ask Steve Sosnick. He joins us now here in the studio from Interactive Brokers, where he is the chief strategist. Steve, it's great to have you back. I don't know why it's been so long.
Too long.
It's been too long. We'll fix that.
So what do you think? I mean, earnings, in the way I think about it, earnings usually involves a call and then a chief executive who says, yeah, that was then, but the future will look like this. Whereas with the data, it's all pretty stale and old by the time it hits my screen, and it doesn't have an outlook.
And that's why this is such a weird earnings season, because could you imagine even 3 months ago if a company said, we don't know what's going on, we're going to withdraw our guidance, the stock would be down double digits. I don't care what the stock is. Now you're getting a pass on that. And I think it's pretty much a 3-month pass because, like you said, the data is old. There is no clarity. There is no ability to give guidance. So the market is giving them a pass. And I think that companies in some ways are taking advantage of the little, spring break that they're getting. Mm-hmm. But that has a finite life to it. It certainly won't last more than till next quarter. But that's, I think, one of the reasons for the recent optimism we've seen.
Yeah, it's funny that you mentioned that earnings have a look ahead, because we know that this quarter that we haven't seen a lot of guidance, or at least guidance that you can dig your teeth into. So let's talk about the data, because the Fed has a really interesting problem on their hands, whether they focus on inflation, what's potentially going to happen there with these shifting tariff policies, or do they focus on the labor market and the growth outlook, which people aren't feeling too hot about either.
This is kind of the problem. It's really you've hit upon the two aspects of the dual mandate, and we really haven't gotten a lot of clarity as to what they will do if the two portions conflict. I think they lean in toward prices, because my gut tells me, and some of the rhetoric that's come out has been, they don't want to reignite inflation. That's harder to deal with, and especially with tariffs. Whether you can say they're the T word, transitory, but there's certainly an effect on pricing. You were reporting on Shein and Temu before and Amazon has got to come down with this. So that is a difficult aspect for them to deal with. So I think ultimately, unless the labor market really gets terrible, and we're probably not going to hear that on Friday, then the Fed remains probably more focused on prices, and that keeps them on the sideline. My feeling about rate cuts, where we're still seeing about 3 to 4 priced in for the year, is be careful what you wish for, because if we're getting those price cuts, it means that things are, if we're getting those rate cuts rather, it means things are probably pretty terrible.
You know, I hear you on the Wednesday being the most important kind of moment of the week, but what about the pregame? What about the consumer confidence data? If we're,
Tuesday.
Tuesday, and you know, I think a lot of people right now are having trouble parsing through the soft data versus the hard data. But if consumers don't feel good, if you have Temu, Shein starting to raise prices to this degree, and people worried about inflation among the U.S. companies, what do you make of that?
Well, I think it's impossible to ignore. We got a decent number, I guess, on Friday from Michigan, you know, because they come every 2 weeks. So it was better than feared. But my take at the time was, yeah, better than feared, but they still stink. And so, you know, we can't really get around that. And I think a lot of the numbers have been okay. That's largely because of people front-ending stuff. I know very specifically. I bought stuff that I was kind of on the fence about. I'm like, you know what?
This is going to be forward.
I did pull it forward. I bought a new TV because I wasn't sure. I bought, you know, a lot of little things that I figured were all going to be subject to tariffs. And so this is the kind of stuff that I think people are doing. That doesn't mean they're confident. It means they're scared, but it means in the numbers that are coming out, at least in the short term, they're still going to look reasonably good.
Well, it's funny to hear you say that, because Kate Moore told us on Friday she pulled forward her purchase of Hoka's. And, you know, when you think about Apple reporting this week, there's a lot of concern that it's a one-time pull forward.
I mean, I bought a whole case of maple syrup. Rather, my wife did, thinking.
Should I be shopping?
Well, or not, right? Because I think a lot of people, you know, I'm not going to buy a new motorcycle right now because I want to wait and see if we have a horrible recession and I get fired, right? A lot of people are thinking the same thing.
Well, yeah, well, that's the difference. You know, I think that's where it comes maybe down to cars and things of, you know, major purchase, big real purchases like a motorcycle. But I think the Apple stuff got pulled forward. I know my wife was very much, you know, should I get the iPhone now or not? But then it got carved out, so the rush was over. But this is the mentality. But that plays into that's how you can have this weird conundrum of lousy sentiment, but actually good numbers coming in from retailers.
And I mean, one of the things we talked about on Friday is this is how you talk yourself into a recession. If you start exhibiting these kind of behaviors, you start pulling things forward, and then you cut your spending, you know, psychology, that feedback loop kicks in. But let's bring this conversation to the markets, because how does an investor position themselves among all this uncertainty, companies pulling guidance, you know, the eco data, everything that's not real time feels stale? You've started to see a lot of really defensive sort of names outperform in this market. Is that sustainable?
I think the defensive outperformance is sustainable because even in spite of the fact that last week what we saw was sort of the rush back into the Mag 7 and friends, because I think that's sort of the two different playbooks. I think you still have a lot of investors who are just, they know that these things have gone up over the last 5 years pretty much routinely. Every dip has been a buying opportunity. But there's a difference between buying dips and chasing rallies. And I do think we're getting a little bit of rally chasing in here. And that's where my caution comes in. I think it's never wrong to sort of dip your toe in the water, have some risk management, see if you've got a buyable opportunity. Chasing a rally is a whole different thing, especially when you're dealing with all this massive uncertainty, especially when I look at it as maybe being in the eye of the hurricane right now, because we've got this tariff reprieve, quote unquote, but we really don't know how it's going to play out. And, you know, again, I think to your point, I think we may be talking ourselves into a bit of bad feelings. It's not going to be too bad as long as people have jobs. But you're starting to hear from smaller and medium-sized businesses that they are truly nervous. Their sentiment numbers are terrible, even worse than the average consumer. And, you know, it's hard to ignore that engine of the economy.
Absolutely. Got to keep an eye out for those small businesses. Huge employers. Steve Sosnick, we thank you so much, of course, from Interactive Brokers. Katie, we're taking a look at these markets.
Yeah, not too much to look at. You can see the S&P 500. It's really been bouncing around in a low volume range. Not a rage. It's only up about 0.2%. You take a look at the NASDAQ 100, a little bit more direction there to the downside, down about 0.1%. The 10-year yield, the bond market, pretty well behaved. We'll bring you the sector breakdown next. This is Open Interest. All All right, welcome back to Open Interest. Let's break down this market right now because as we've been saying, the S&P 500, it's not moving too much, which is interesting because we actually have pretty good breadth right now. You can see that we have nearly 400 names that are in the green, 107 in the red right now, but the big guys aren't moving that much. You can see that the biggest points contributor to the upside right now is Berkshire Hathaway, but it's up less than 10% or 1% rather. It's also up less than 10%, but moving on, AbbVie also higher. Tesla a little bit of a move higher as well, but take a look at what's moving to the downside. And this explains the range that we're in because you have Nvidia lower by nearly 2%, Microsoft, Alphabet lower as well. And you can see this reflected in the sector level breakdown as well. As I mentioned, I mean, more green than red right now. Industrials, financials, materials higher. But then you take a look at the bottom, it's utilities, communication services, and then you have tech down 0.4%. And you guys, tech is absolutely the focus in the markets this week.
Yeah, 100% as we get $20 trillion of earnings, the biggest week of the quarter. Of course, Nvidia doesn't come until the end of May, and that is obviously a huge one that's affecting the market today. Coming up, M&A medicine. We're going to talk about M&A in medicine because German pharma company Merck is buying SpringWorks for nearly $4 billion, and we're going to speak to the CEO of Merck. And I guess, Shanali, are we seeing a ton of M&A this year? Not as much as expected, but...
and starts in the last week. It's slowly coming back. Does it mean prices have bottomed? We're not so sure yet.
I am excited to talk to the CEO of German Merck, though, because it's interesting that they're buying a U.S. biotech, considering the threat of tariffs that's hanging over the pharmaceutical industry. So a lot to discuss and pick apart there. A very interesting signal. That conversation coming up next. This is Open Interest. Welcome back to Open Interest. We're in wait and see mode at the index level in the U.S. equity market right now. A little bit more movement under the surface, though. Let's talk about it all with Bloomberg's Alex Semenova. I know you're starting with NVIDIA. That's actually the biggest points contributor to the downside right now.
Yeah, it's down about 2% right now, Katie. This is after a report from the Wall Street Journal saying that Huawei Technologies in China is getting ready to test a new AI processor, hopefully with the goal, their goal of replacing some products made by NVIDIA. Obviously, this comes at a time when the tech battle with China is heating up, and also at a time when the trade war is also heating up. We remember recently the Trump administration banned NVIDIA from shipping some products to China, and Huawei apparently approached Chinese companies to gauge their interest in this. It's very much in the early stages right now.
Also, keeping an eye here on Eli Lilly. We're seeing a double downgrade over at HSBC. It's going from sell to a buy.
Yeah, so
or buy to a sell, rather.
Exactly. So double downgrade, this is basically, it's going actually, they call it a reduced rating, the equivalent of a sell rating. They said basically that there's too much optimism around the company. They think that the adoption of GLP-1 drugs, some of the data around that is going to disappoint investors who are really bullish on it.
I'm bullish, GLP-1.
Yeah.
God, I wish I could get one of those shots.
You just want someone to ship you a free sample.
Please, please give me a monthly. I'm not talking to Dave Ricks here. Please, Dave. Okay, IBM says it's going to invest $150 billion over the next 5 years. This is, I think, one of a few companies that have made these big, massive announcements, maybe in order to curry favor with the Trump White House, or maybe they just now have a ton of confidence in the U.S. economy.
Yeah, I'm sure it's just a coincidence that suddenly you have, you know, IBM, Apple, Eli Lilly all talking about bringing manufacturing here to the U.S. And you look at the statement from IBM, they said that they're committed to the future of American innovation, igniting new economic opportunity in the U.S. and around the world. Sounds very much like a statement that would appease the Trump administration here. And they are one of the biggest technology employers here in the U.S. So really aiming to create more jobs here over the next 5 years. That investment, $150 billion, about $30 billion is going into research and development, the rest of into manufacturing.
Well, fascinated to see the follow through on that one. IBM shares currently flat at the moment. Our thanks to Bloomberg's Alex Semenova. Meanwhile, it is Monday, and we do have some M&A from German pharma company Merck buying U.S. biotech SpringWorks Therapeutics for $3.9 billion. For context, SpringWorks makes medicines for cancer and rare diseases and is expected to give Merck's healthcare division a boost. I'm pleased to say that Merck CEO Belen Garijo joins us now. Great to have you with us. Really interesting deal to wake up to. And I'm wondering to what extent the concerns over the tariff landscape, particularly when it comes to pharma, factored into this deal.
Look, we don't make M&A for or taking into consideration political aspects. You know, this acquisition or planned acquisition, better said, that we have announced today is really a strategic win-win for both companies. For us, it really accelerates the growth of our pharma pillar. It confirms our long-term commitment to serving patients in areas of high unmet medical need, and it's also very financially robust because it's going to be accretive to our revenues and accelerating the revenues of healthcare from day one. It's going to be accretive to our EPS as of 2027 with a very modest dilution in 25 and 26. So we are extremely excited to work with the teams of SpringWorks as of the date when we come to closing, to be able to maximize the opportunity and deliver on our ambition to breaching to our long-term guidance of healthcare. That means raising and accelerating our growth to mid-single digit.
Hey, Belen, Matt Miller here in New York. I wonder how big of a market the U.S. is for you now and how this will change with SpringWorks. I mean, how much of your revenue, for example, do you rely on the U.S. for?
For the group, the U.S. is our most important market, but healthcare is certainly needing additional scale to be able to be more competitive. And one of the elements that was more important for us when we were looking at potential acquisition targets was the possibility of scaling our biopharma business in the U.S., which we consider to be a very highly attractive market worldwide. So with SpringWorks, our scale in the U.S. will be significantly strengthened, and we will definitely be able to use our capabilities and the teams of SpringWorks to increase our to enhance and increase our presence in the U.S. market.
Now, the two main drugs for SpringWorks are approved in the United States, but even with that, there is still outstanding regulatory approval in Europe. Now, how significant is the downside risk if the EU does not clear those drugs?
Look, the most important source of revenues will continue to be the U.S., but we have a global presence, and obviously we are expecting to be able to offer these two important products to patients worldwide. So we are, based on the most recent information that we have from our conversation with SpringWorks, we are confident that the regulatory approval, as they have confirmed yesterday in their press release, will come at some point in time in Q2 in Europe.
I want to talk about the price tag a little bit because we mentioned this is an equity value of about $3.9 billion. You're paying $47 per share in cash for SpringWorks. That's about a 26% premium. But you do have some analysts suggesting that actually that's a pretty low price tag. Should we see other bidders emerge for SpringWorks? Is Merck prepared to raise its bid?
Look, we have put forward a very compelling offer that recognize the value of SpringWorks. You quoted the premium. We have offered a premium of 26% versus the value of the share in February, before all the speculation about potential takeover happened, that of course brought tremendous volatility to the share price of this company. So we believe this is a very compelling offer that has been unanimously approved already by the board of SpringWorks, and now we need to make sure that we go through the process from signing to closing to be able to once again materialize the acquisition.
Belen, I look at the FA function on the Bloomberg, and I see that you have over 3 billion euros in cash and equivalents, and of course you use debt to fund these acquisitions, and you have shares as well. Are you open to any more deals or even maybe larger deals to continue to build up your life sciences division? You have that and also electronics.
At the group level, our M&A priorities have not changed. So today, we have materialized very consistently what we have been communicating to the markets and to our investors in recent months. So we really delivered and walked the talk very consistently on our healthcare pillar. However, our situation, our balance sheet is very strong, and we will continue to look for opportunities to stay on track and eventually cover. Without any precipitation, we have not only the opportunity, but we have the desire and the appetite to fuel our life science sector and to keep and revitalize and position life science in a very solid platform for long term as well.
Our thank you to the CEO of Germany's Merck. Of course, that is Belen Garijo. And on the heels of a deal, nonetheless. Now, coming up, we're going to talk to the CEO of Babylist, who has taken out a full-page ad in the Washington Post calling for a tariff reprieve. Natalie Gordon, who's the company's founder and CEO, joins us next. This is Bloomberg Open Interest.
Small businesses, which are vital to our economy, are feeling as though disproportionate harm will be caused to companies like ours because of not only the current and proposed tariffs, but because of the general uncertainty around them. And so there is a lot of frustration, and there is a lot of concern around different ways that we can, move forward as sustainable businesses.
That was Juliette Wine, CEO, Allison Luvera, speaking on open interest after she wrote an open letter to President Trump and lawmakers urging tariff exemptions on small businesses. Let's talk about one of them right now, Babylist. The CEO, Natalie Gordon, is calling for a tariff break on critical baby products like car seats, cribs, and strollers, almost all of which are made in China. She published a full-page ad in the Washington Post voicing her concerns, and Natalie Gordon joins us now. Natalie, great to have you on the program. Babylist is, you have reminded me, is a registry platform, so you're not a direct retailer, but you have an interest in these products. I imagine you get a cut on certain sales. And how does it look right now to you in terms of shipments coming from China to the U.S. of these products?
Hi, Matt. It's so good to see you again. Babylist, we are a registry platform. We are also a retailer ourselves. And we just celebrated shipping actually having the 100th million gift given on the platform. And so this is all we do. We talk to our vendors, manufacturers in the industry every single day. And what has happened is there is the 145% tariff on goods coming from China. And almost all essential baby gear, 97% of car seats and strollers, are currently manufactured in China. And so what we have seen from our vendors is they are not able to absorb these costs. They're figuring out how much they're actually going to increase their costs to customers. And what we've seen for products shipped from China, we've even seen some manufacturers hold back products and not ship it because of this uncertainty. where we actually foresee out of stocks for some products over the coming months.
Natalie, you have some interesting numbers in the ad that you had put out. This idea that parents in their first year of having a child are already paying $20,300 and that you expect that those costs could rise by $1,000. Now, it is enormously expensive to have and care for a child. You're saying now that there could also be shortages throughout this year. What are people doing in the event that these don't get rolled back in the near term? How are people coping with those realities?
That's a great question. We're talking to our customers every day. They're worried. They're concerned. They're actually saying, should I buy everything now before prices go up for having a 2-year-old? What we really don't want them to do is have to make trade-offs, especially on safety.
Well, that's the thing, Natalie. I mean, some of the things that we're talking about, car seats, for example, you need a car seat. So, I mean, I'm wondering what the worst case scenario is, given that you have to buy car seats. I mean, do you see people shifting more into accepting hand-me-downs, which may be older and potentially expired? Or how do you talk to your clients, your customers, your vendors about that possibility?
Yeah. Secondhand items, we asked our users, 67% actually think getting secondhand products is a great way to save money so they can get everything they need. We just launched an open to secondhand feature on our registry, and it's been widely adopted. We've had 350,000 items actually marked as open to secondhand. Secondhand, though, you're naming something very important. It is very important that your car seat is safe. And so knowing who you're getting it from is very important. We work with a secondhand marketplace called Good Buy Gear that actually does safety testing of products. But it is very important that your car seat is unexpired, has never been in an accident, and you don't know that if you're getting it from Facebook Marketplace.
My parents used to put me in the back of the pickup truck.
Just bubble wrap.
And now I'm doing like rear-facing car seats until the kid is 17. I wonder if you're starting to see any of this stuff manufactured here, Natalie. Do you see any shift? Are people making car seats? Are people making strollers in the U.S. that they normally would have made in, I don't know, China or Finland?
The industry really wants to figure that out. That's why we're asking for this reprieve. It takes time and it takes investment to move supply chain, especially to move supply chain here to the United States for products that are not currently manufactured in the United States. And so I think really what the industry is asking for is give us time to figure this out. Figuring that out while navigating these current tariffs for their current supply chain is absolutely crushing.
Babylist CEO Natalie Gordon. We're looking forward to seeing how the story plays out. Now, coming up, it's the worst blackout for Europe in years. We're going to give you details from the ground in Madrid. Stick with us. This is Bloomberg Open Interest.
All right, sharp swings in power caused a network outage that left almost all of Spain and all of Portugal in the dark today, making it the worst blackout in Europe in years. Here with the latest is Bloomberg's Clara Hernanz Lizarraga, who joins us from Madrid. So, Clara, how bad was it? I mean, phone lines were down as well?
Yeah, I mean, it's still ongoing. There's been a widespread power outage that's affected millions of people and disrupted essential services across the whole peninsula. While there's parts of Spain that have gradually come back online in the last couple of hours, restoring all the supply will take until at least the evening. And here in Madrid, the power cuts have paralyzed everything from telecommunications, transportation, stores, buildings. Traffic lights have stopped working. There's
Oh, it sounds like we just lost her.
Yeah, we know that obviously there's a lot going on. I can't imagine what it looks like on the ground there. Of course, we were talking to Clara over the phone, given that can't exactly fire up the Zoom connection right now.
Well, a lot of phone lines were down as well, as she was just saying, right? So we had a power outage causing problems across, I guess, communications assets.
Communications assets as well as transport assets, public transport, airports, phone services, flights canceled. So very difficult situation across the peninsula, as she was saying.
Yeah, and in terms of why there's an investigation ongoing, this is from the European Union Agency for Cybersecurity saying in an emailed statement that for the moment, the investigation seems to point out a technical/cable issue, though that they are closely monitoring the situation. They're in contact with national and EU authorities because obviously the muscle memory of the past few years, a lot of folks are thinking potentially related to cybersecurity, but at least for now, it seems to be pointing to a technical and a cable issue. But let's take a look at these U.S. markets
well, hang
right
on.
now.
I think there's a little bit more to talk about with regards to Spain, because when I first heard this announcement this morning around 6:30 a.m., I looked at the WEI screen on the Bloomberg to see if the IBEX was still trading, and it was, and it continues to trade. It's currently up 0.75%. So even with these power outages and communication breakdown, to quote one of the greatest rock bands in all of history, their market continues to rally, and the IBEX is up 16% year to date, outperforming every other European index, and obviously far outperforming the U.S. assets. So.
Who's the rock band? I didn't get the reference.
Communication breakdown. It's always the same.
I totally missed that myself.
It's Led Zeppelin,
I
guys.
will say,
Led Zeppelin.
Led Zeppelin.
Remarkable to see the market hold up. Unusual for a countrywide blackout like this.
I have to say, though, I can't imagine that volume is pretty heavy right now. The markets may be open, but I don't know who is.
Fortunately, we can see with the Bloomberg terminal that volume is down more than 41% compared to the 30-day average. It's not much better here, right?
No, it's extremely quiet right now. As we keep talking about, there's a very hefty week this week, but we're not necessarily getting that kicked off until tomorrow. So let's talk about the trading diary. What do we have?
Yeah, as the S&P sits unchanged, we might as well go to the calendar. Today, Canadians head to the polls in a snap vote called by new Prime Minister Mark Carney. And then this week, President Trump marks his 100th day in office. If you count January 20th, his inauguration day is day 1, then tomorrow is day 100. It's simple math. You just look at the calendar and count days.
I will say on the first 100 days, if the declines hold, who knows? Anything could happen today. But currently, the current stats point to that this would be the first 100 days for any president as measured by the stock market performance since 1974.
The worst first 100 days.
Did I say best?
We're certainly a time.
Worst.
Yes, the worst first 100 days.
Okay, it rhymes.
That many people are looking at too. I mean, the 70s analogies are some ones that keep on sounding louder and louder as people get worried about that inflationary force.
Stagflation is on your mind, Sonali
Yeah.
Basak. It's also the busiest week of earnings season for this quarter. 4 of the 7 magnificent mega cap tech companies report: Microsoft, Meta, Apple, and Amazon. And we're also going to get reports from other very important companies, General Motors, for example. And when you talk about global trade, we now know that it is all about cars. We also get Starbucks and Starbucks,
yeah.
And UPS. That's very important to you.
Starbucks, I will say, I used to buy a grande cold brew every single morning. I have since pulled back because it costs over $5 for a 16-ounce serving there. So
you've both gone to company coffee, because usually Sonali Basak has a case of Celsius in front of her. And
full case.
I'm proud of you guys for getting a little bit.
180 companies reporting this week.
A lot of companies are reporting this week. And then, of course, we get back to the all-important economic data, the granddaddy of all eco-stats. On Friday, we get the U.S. jobs report. But it does seem like all of this eco data is going to be pretty backward-looking compared to the earnings outlooks that we're expecting.
But we were having this conversation with Steve Sosnick. Yes, in a typical week, perhaps, but we know that a lot of companies have been pulling guidance or just saying, we don't know. Here are the possible scenarios, because it's pretty difficult to forecast what the next 3 months, what the next year ahead is going to look like.
Eye of the hurricane, he calls it.
Absolutely. Well, we'll see you back here tomorrow with Anastasia Amoroso of iCapital and Jill Carey Hall of Bank America. This is Open Interest.